Welcome to the InterMarket Analysis video update. This is a video that I do once a week where we look outside of the S&P 500 at other sectors, other indexes, and even other markets, because sometimes we can get some insight about what is happening in the S&P by comparing it and studying other markets. I also do a look at earnings and we look at valuations of the S&P 500, both on a historical basis and on a forward-looking basis. And I also do a pretty intensive look at growth versus value. Growth is when you want to buy low, sell high. Value are stocks that tend to hold up better when the market's in decline and when the market itself is becoming more defensive. This is being prepared for Monday, July 29th. I do have a thing called the SPXInvesting Program. It launched in June. It's still free. I'm probably going to lock it down in August. If you want to learn more about the program, there are links in the description below this video. There's also another link that will take you to a playlist that explains more about the program. If you have questions, here's an email address where I can be contacted. This video that you're watching right now is just one of many videos that I put out each week. This is a weekly video, and for my analysis and commentary, everything really boils down to the daily video, and all the other videos that I put out each week are considered to be supplemental videos, or they're meant just to tie into the daily analysis that is done. The first area that we'll look at is S&P 500 valuation. We use a thing called the PE ratio, the price to earnings ratio, and we can see right now with the black line with the S&P, even though it's been declining this past couple of weeks, the red dashed line, this is a PE ratio of 20. When we get to 20 or above on a historical basis, that means that the market is considered to be expensive. And we've been expensive now for quite some time. Doesn't seem to really bother the market. We don't really use this to make decisions, but it's just good to know where we're at on a valuation basis. Here's also another chart of those same dashed lines going all the way back to 1980 and different events that happened and what the valuations were at that time. A gentleman named Robert Shiller kind of took a new approach to using the PE ratio where he smooths it out over a period of time. This is called the Shiller PE ratio. You also may know it as CAPE, C-A-P-E. And this goes all the way back to the 1800s to give us a little bit of perspective here. And the current value is at 35.21. Well, what does that mean? Well, we can look over time and we see that the median and the mean is anywhere from 16 to 17. And it's been that way for a number of years now. So when we look at this at 35 and the median and the mean is 16 to 17, the market is also considered to be pretty expensive right now. Now, there's other ways that you can use this measurement. I really just look at these raw numbers right here. But the market looks forward. And this is a chart from Edward Yardeni, who plots the different forward-looking PE ratios. And that's what the market really keys off of. The purple area up here is the mega cap 8. These are the stocks that everybody's been hearing about, and everybody seems to love these days, except over the last week or 2 weeks, roughly, where the purple line is actually coming down a little bit, but still giving us a very high reading at 30. Now, we still use that 10, 15, 20 scale, so we're well above 20, but folks don't seem to mind. They think these are the real growth companies. This is where the future is at as far as stocks that are going to be really helping the economy grow, and they don't mind having such a high valuation. We look at the S&P, which is in red, coming in just over that 20 level, so it's also considered expensive, even on a forward-looking basis, is the S&P 500. And then we also have the mid caps and the small caps. And the small caps have really been coming on in favor, and I'll talk more about that throughout this video. We finally got over that 15 level with the small caps. We're at 15.4. That's the green line. And then the blue line are the mid caps at 15.7. So as their price goes up, usually that increases the PE ratio. And we don't really use PE ratios to make decisions. This is more just for knowing what is the current climate of the market. Now, there are some people that might use this as a timing mechanism, but it can stay extreme or fairly priced or not necessarily undervalued for a long time, but it can stay in those other areas for extended periods of time, and you might miss out on some real moves if you wait for these things to all line up. Then we look at growth versus value. This is a pure growth index. So we look at growth all by itself. And when the blue line's above the red line, that means we're in an uptrend. Now, lately, as the market's been shifting and going through a rotation and even experiencing some declines, we have been seeing growth coming down, but it's still in a longer term uptrend. However, it has fallen below its 50-period moving average. Then we look at a pure growth or pure value index here, also in an uptrend. It had been underperforming when compared to growth, but lately it's been coming on a little bit stronger. Now we do some ratios between the two. We have growth to value on top, and this shows how growth had really been outperforming, and it still is, but lately this ratio has really been coming down as value has seen more favor. Then on the bottom is an inverse of that same chart because we might get some insight by looking at the same thing only upside down. Also, these are calculated a little bit differently, and so the moving averages that are used on these ratios, they cross at slightly different times. But this shows how value has been underperforming growth, but lately value has been starting to outperform growth. This, on one hand, gives us a little bit of a concern because usually when the market is getting ready to be defensive or decline, value will start to really come on strong and growth will start to show weakness. That's what we saw at the end of 2021. And then we went into 2022, which was a down year and a pretty difficult year for investors. This could also mean that instead of the big mega caps really controlling the market and really shooting the indexes higher, now it seems to be spreading out across the S&P itself because there's 503 stocks in that index. And we're also seeing the broader market doing better. And we could also be seeing where small caps are now coming back into favor because there's a real anticipation that the Fed is going to be lowering interest rates. And small caps, they have to borrow a lot of money. They don't have the huge cash reserves that the bigger companies do, and so they're more susceptible to interest rates. And that could also be helping some of the market actually shift into a new climate. And we look at growth versus value again here, looking at a couple of ETFs with a longer term chart showing how growth is outperforming, but lately has been pulling back. Here's an inverse showing how value was underperforming, but has been bouncing up lately. Then we look at a couple of different indexes here, growth versus value, showing how growth has been outperforming, but pulling back. And then this is a more shorter term chart here. When this is going down, that means value is underperforming, but lately has been bouncing back up as well. Here's another one showing that growth is outperforming value. Then these are a couple of ETFs, and I show this usually in every daily video now, where the growth ETF has really been outperforming, but lately coming back, and we're now inside the rainbow. Here's an inverse showing those same two ETFs, how value had been underperforming, but has since bouncing back up. So this is just something that we're keeping an eye on. This doesn't necessarily mean that things are turning more negative or even more defensive. It could mean that, and that's what we're waiting to see as things play out. It could also mean this rotation going on is just seeing the broad market participating more in the actual advances of the market. And we look at the small caps. Small caps have been doing quite well lately, seem to be breaking out here when we look at the index. But look at the growth to value ratio. It's really been going down lately. And we're seeing mid caps also doing better these days, but the growth to value ratio has been going down as well. Then what I watch the most is the S&P growth to value ratio, where we've been seeing a real drop off with the S&P recently, and we've also been seeing a drop off with the growth to value ratio here. And we keep an eye on inflation. This is a monthly chart of the CRB index, and these are commodities. And typically when this is going up, that tends to be more inflationary. We've been chopping sideways here for the last couple of years, and now we're starting to drop below the moving average. And this is suggesting, according to this, that inflation is not necessarily a problem. We do a ratio down below, also on a monthly basis, and it shows that inflation versus deflation has been decreasing, and we're still below a declining moving average. Here is a daily chart of the CRB index where it's been pulling back lately, even though it's still in a longer term uptrend. We look at the Baltic Dry Index, which is still in a choppy uptrend here. Typically, when this is going up, that's more inflationary. When this is going down, that tends to be more deflationary, but really it's been scrunching up lately. Some other markets that we keep an eye on, I don't actively participate in these markets, but we just want to keep an eye on them. Markets like aluminum, which is still in an uptrend, but pulling all the way back to its 200-day moving average. Corn has been really going down and is in a downtrend. Wheat is also in a downtrend. And we'll keep an eye on fertilizer over the last 3 months or so, where it hasn't really been breaking up or down as far as the price is concerned. Oil, which had got up into the 80 range, is now dropping back into the high 70s range. We keep an eye on gas, which is still in a downtrend, even though we're in the summer months. Keep an eye on diesel, which over the last number of months has been declining. So this doesn't necessarily look inflationary. Heating oil, of course, we are in the middle of summer now, but this is still having a tendency to go down. Natural gas is also in a decline, even though we saw a recent golden cross here. We saw enough to cross, and now we've been dropping back below this. Copper, this is one that we look at a little closer because this is known as Dr. Copper. It's a kind of a gauge of the economy. When copper's going up, that means stronger economic conditions are anticipated by the market. When this is going down, that means weaker economic growth is expected. And it's still in an uptrend. And that's been just suggesting that the economy is still looking pretty good. However, it's really been pulling back now. It's still in an uptrend, but it's come all the way back down. It's actually dealing with its 200-day moving average now. Then we look at copper and then gold, and we take a ratio between the two. When this is going down, that means the copper is underperforming gold. Here's a longer term look at that same chart. The black area, that's the copper to gold ratio. Just to give you a little bit of context, we also plot the 2-year and the 10-year yields, which have been coming down lately. And so this is just suggesting that we could be seeing a little bit of weakness as far as the economy is concerned. We look at gold all by itself, which has been chopping more or less sideways, but it's still in an uptrend. Silver also dropping below its 50-day moving average, but also in an uptrend. And we look at the closing price for gold on top, the closing price for silver on the bottom, and we can see that the correlation between the two is actually kind of strong now, which kind of makes sense. You tend to say silver and gold together, just like the song in the Christmas Rudolph the Red-Nosed Reindeer show. But sometimes they kind of get out of whack with each other. Well, right now they're having a tendency to either go up or down in tandem. And we look at a gold to silver ratio on top. When this is going up, that means gold is outperforming. When this is going down, that means silver is outperforming. And then we plot the US dollar index down below. We're not really getting any insight from this chart right now because the correlation is pretty much neutral. Here's the dollar index, a daily chart where it's still in an uptrend, even though we've been seeing a bit of a pullback lately with the dollar. And the stock market likes a weaker dollar. This goes back over 3 years where we broke out above this downward sloping trend line, but lately we've been just chopping more or less sideways with the dollar. Then the euro, which is in a slight downtrend compared to the US dollar. And then down below here is the US dollar index. And I have a breakout chart to show you in just a moment. We also put the Japanese yen on here. Even though it's been bouncing up recently against the dollar, it's still in a longer term decline. Here is the chart of the euro to the dollar, where we just have a slight death cross here. Even though the euro was starting to break out against the dollar, it's been coming back, and we're still in a slight downtrend for the time being. This is the Japanese yen to the US dollar, where it is in a longer term downtrend. There's been some government intervention in fear that the Japanese yen is it's going down too much compared to the dollar. So we've been seeing that bouncing back up lately. The British pound is in an uptrend when compared to the US dollar. Now we'll look at some different indexes, and I show this in the daily video. When we see the red line here, that's the equal weight S&P 500, where all stocks are treated the same. It's actually outperforming right now the S&P 500, which is a weighted index, and that takes more of the big Magnificent Seven stocks. They're calculated into the index. And when the red line's above this, that just means the broader market is actually improving. We look at a ratio here. When this is going down, that means the equal weight index is underperforming. Well, now it's starting to bounce back up as we're seeing more improvement across the broader market. Then we do a ratio between stocks, the S&P 500, and commodities, the CRB index, showing how stocks continue to outperform. Here's an inverse showing how commodities are underperforming stocks. We look at the NASDAQ 100, which lately has been a little bit weaker, but has been one of the stronger indexes lately, and the S&P 500, which has also been really good in 2024. Both of them have been under some pressure lately because the Magnificent Seven stocks, they're in both indexes. And so we're still in an uptrend here with the NASDAQ 100 outperforming the S&P 500, but it has been pulling back. The S&P 500 is more balanced. It has more value in there. There's more stocks in there. And so when the NASDAQ 100 is under more pressure and is actually looking more negative at the present time, the S&P 500 tends to hold up a little better, and that's why we're seeing this ratio going down. We look at the S&P 100, which are the biggest stocks in the S&P 500. They have been really leading things higher, lately seeing some weakness now. The NASDAQ, which has also been doing well, and the S&P 500 also doing well, seeing some weakness in both areas right now, but we're still in a longer-term uptrend, even though this ratio has been pulling back. The NASDAQ 100 is continuing to underperform the NASDAQ itself. When we were really screaming higher, the NASDAQ 100 tends to lead the way. Now that we're possibly shifting over a little bit, the NASDAQ is slowing down when compared to the NASDAQ 100 is slowing down compared to the NASDAQ. Then we look at the mega caps. These are the really big companies and compare it with the equal weight index. This had really been going up, showing how the mega caps are outperforming, but lately we've been seeing them pulling back. Small caps, which seem to be in favor right now, the ratio here is small caps to the S&P. That's the red line, where it had been in a steady decline here over the last few years. Lately, it's really been coming on strong, and I'll address this a little bit more later as well. We also look at a ratio between the small caps and the S&P, where they are showing a real improvement, but longer term, they're still in a downtrend when we do a comparison between both of the indexes. The big software companies, not really breaking out to the upside, pretty much just chopping along sideways, but they are in an uptrend. The mega caps, which were really, really strong, now starting to pull back and actually falling under their 50-day moving average. The robotics and AI ETF, as we're seeing a little bit of weakness in this sector, we're coming back down into the rainbow, not the sector, in this ETF. Then we do a ratio between the robotics and AI ETF and the tech sector. It's actually showing a little bit of an improvement here. Now, you'd think with AI being all the buzz and everything, and NVIDIA's in this ETF, it really has been underperforming. But as the tech sector's been doing a little bit worse, the AI ETF is actually holding up a bit better right now. And we look at the Dow Jones Composite Average, which is the Dow, the transports, and the utilities all put into one composite average. Still looking pretty solid right here and in an uptrend. We look at the S&P 500 and compare it with shorter-term bonds, 1 to 3 years. The S&P has been outperforming, but now we've been pulling back and coming into the rainbow. We look at the S&P 1500 and also compare it with shorter-term bonds, doing pretty well here, but falling back recently and coming into the rainbow itself. We look at another broad market measure and compare it with further out bonds, 3 to 7 years, also coming into the rainbow now. The total U.S. stock ETF set a recent all-time high, coming down, but still above its 50-day moving average. We look at low volatility stocks, which are holding up a little bit better if the market is getting a little bit more defensive. And this has been in a pretty solid uptrend for all of 2024. But then when we look at a ratio between the low volatility ETF and the S&P, we are in a solid downtrend, but lately this has been bouncing back up. We look at the tech sector, the darling sector, compare it with 3 to 7 year bonds, also pulling back and coming into the rainbow recently. Then we look at the advanced decline line studies, and I do show this in the daily video as well, and we're holding up better now. The NYSE common stock is above the moving average and going up, also looking better with the S&P 500, the mid caps, and the small caps. Then we look at Dow theory, and there's traditional Dow theory, which really just looks at the Dow and the transports, because we're looking for a confirmation here. And the perma bears, they're like, we haven't seen a confirmation with the transports. The Dow set an all-time high, but the transports haven't. Ooh, that's danger, danger. The market's going to fall apart. Well, that's been going on for a long time now. And I'm not saying don't respect that, because we should see that in a stronger environment. But it's nothing that we necessarily use to make decisions on either. At least I don't. But the transportation sector and the index has really been underperforming, but lately it's been bouncing back up. I also add utilities to traditional Dow theory, and this is really going up as well. And now we have to try to figure out, are utilities going up because they're turning more defensive? That's what we saw at the end of 2021 before we went into 2022. Or it's all this electricity being needed that they use for mining for cryptos, and it's going to be used for AI because there's an awful lot of electricity needed for those things. Also, utilities could be going up in the anticipation that interest rates are coming down because there's a lot of borrowing that goes on with different utilities. Nonetheless, we want to keep an eye on this, and we've been watching this for a while because sometimes when utilities go up, that can signal that the market is becoming more defensive. This is the transportation index by itself. And even though it's been bouncing back up, we have a long ways to go even to get back to previous highs, let alone the all-time highs set in 2021. We do a ratio between the transports and the S&P 500. When this is going down, that means the transports are underperforming. And this could actually be beneficial for the economy if the transports really kick into gear, so to speak, and start to show some more follow-through improvement. That could actually end up helping the stock market. We look at another ratio between the Dow and the transports, just more or less chopping sideways recently. When this is going up, that means the Dow is outperforming. When this is going down, that means transports are outperforming. And we look at a correlation between the S&P 500 instead of the Dow, and then the transports in the middle. And they're having a kind of strong correlated relationship right now. We get up into this red area. It means they're probably going up or down more or less in tandem with each other right now. And here's a new look at Dow theory, where instead of using the Dow, why don't we use the S&P 500? And instead of using the transports, why don't we use the NASDAQ? And we're seeing some weakness here right now as we've been pulling back after setting recent all-time highs. Then we break this down a little bit further. Instead of using the S&P 500, why not use the S&P 500 equal weight index on top? And this is coming off of recent all-time highs here. We finally saw a breakout because this was giving us a little concern due to a negative divergence, where when we compare it down below to the QQQ equal weight, which is the NASDAQ 100, it had been setting in a series of highs and breaking out above these previous prices where the S&P was not. Finally, we did see a confirmation here. But as the NASDAQ 100 has been under more pressure, it's actually declining faster right now. The FANG index, Facebook, Apple, Amazon, Netflix, Google, falling down below its 50-period moving average, but still in an overall uptrend. And I'm just keeping an eye on this. If we really continue to fall, we'll be looking for different areas of possible support. The Wilshire 5000, which is another broad market index, came down to its 50-day moving average. It's still above it for right now. This is suggesting that the broader market is looking positive and holding on to support. ARK, which has been a real disappointment here. It was up a little bit on Friday, but it's now in a downtrend on the daily chart as well as on the weekly chart. And we take the all world, which are stocks outside of the US, and we look at them all by themselves. They are in an uptrend, but falling back to its 50-day moving average. Then we do a ratio between US stocks and the rest of the world stocks. This is showing even though US stocks have been under pressure lately, we've been chopping sideways, but we're still above an advancing 50-period moving average. So US stocks are outperforming. And here's a monthly chart of a ratio between US stocks, the S&P 500, And the EFA ratio, these are Europe stocks, Australian stocks, Asian stocks, and stocks in the Far East. And this ratio continues to go up, and we're above an advancing moving average. And again, this is a monthly chart, so it's longer term. And then we put an oscillator on here to judge the momentum, and that's continuing to go up. So for right now, in the bigger picture, US stocks are continuing to outperform. I really keep an eye on bonds, stocks and bonds, and they really interact with each other. This is the price of bonds, where they're continuing to be in an overall uptrend here. Then we look at the Pring World Bond Index, where this is actually in a downtrend. It's been really choppy lately. So US bonds are hanging in there a little bit better, but when we compare them to world bonds, the world bonds aren't doing quite as well right now. We look at stocks to bonds on a monthly chart and take a ratio of that. Even though we're ticking down here, it shows that stocks continue to outperform. Then here's an inverse of that same basic concept, only on a daily chart, where when this is going down, that means bonds are underperforming stocks, even though we've been turning back up lately. High yield bonds, also known as junk bonds, continue to hold up and look pretty strong. Investment grade bonds, these are more conservative bonds from the more established companies and even government bonds here, still in an uptrend, but has a long ways to go to get back to its previous all-time highs. Then we do a ratio between the riskier bonds or junk bonds and the more conservative bonds, and they've been outperforming. Folks have been willing to take on more risk to get a better yield, and that's when we see this ratio going up. We're starting to come down a little bit as we are potentially seeing an interest rate shifting environment here, and folks may be getting out of the junk bonds and starting to get into the more conservative bonds because they can lock in very safe bonds at higher rates for longer that way. And that's what happens when we see this ratio going down. And we look at a correlation between stocks and bonds, they're having a fairly strong tendency to go in the same direction at the same time. We look at the corporate bond index, which continues to be in an uptrend, and the 10-year yield with some Fibonacci lines on here, but we're far away from all of these, so we're not really getting any insight from this. Then we look at a long-term chart of the 10-year yield, and we are shifting into a higher interest rate environment. At least that's the way it appears right now. And we look at the 30-year yield and also place some Fibonacci retracement levels on here, but not really getting any insight from this. Then we look at the S&P 500 and compare it with the 10-year yield. When this is going up, that means stocks are outperforming the rise or fall in interest rates. And this is another chart that I show quite often. This is where 3 to 7 year bonds are underperforming stocks, even though they've been bouncing back up lately. Junk bonds still continue to hold up quite well, and they more or less follow what the general stock market is doing. And we do a ratio between junk bonds and government bonds, and this is continuing to go up even though it's been pulling back lately. If we see this ratio really turn and start to go down, that means there's more of a shift from the riskier bonds over to the more conservative bonds, and usually we're in a falling interest rate environment at that time. Then we want to keep an eye on the 7 to 10 year bond ETF. This is bonds based on price, where they continue to be in a longer term uptrend. This is a daily chart of yields across the different maturities, where overall we have been declining. Here's a weekly chart looking internationally, where we have US and UK rates. They're the highest, and German rates, and then in red are the Japanese rates. And then we look at the MOVE index, which measures the volatility of bonds. Then in the middle area is the VIX, which measures the volatility of stocks. They're having a pretty strong correlated relationship. Now, this isn't measuring price. This is measuring volatility between the top chart and the middle chart. And so they're both getting a little bit more vulnerable right now as we're potentially seeing a shift and a rotation in the market. And we look at this again, the MOVE index on top, the VIX, and then we look at the correlation between the two down below as well, and it's still a pretty strong relationship. Then we look at the price of the 30-year ETF, that's the long-term bond, on a monthly basis, and it's continuing to go down, but lately we've been seeing it coming back up and actually trying to go above the moving average. Then on the bottom, we do a ratio between bonds and the CRB index, and this just shows that even though the 30-year bond is declining, it's still outperforming when we look at this on a ratio basis with commodities. Then I go through a number of different sector studies here. This is the material sector, and I just go through these in alphabetical order according to their symbol. When you look at the material sector all by itself, it's looking like it's pretty strong. It's above its 50-day moving average. Then down below, we look at a relative strength ratio. That's red, and this is showing some improvement here. And we look at the momentum compared to the S&P, and that's also positive, but it has been coming down a little bit. Then we do a ratio between materials and the S&P, where it's been in a downtrend, but lately is we're seeing a little bit of shift in the market. This has been coming back up. Then we look at communication. This has been one of the stronger areas of the market. It's now falling down below its 50-day moving average, and we're seeing some weakness on a relative strength basis, and we're negative, but seeing a little bit of improvement with the momentum. Then we do a ratio comparing the communication sector with the S&P 500. It's still in an uptrend, but it's not been showing the strength of like what we've been seeing before this. And here's energy, which is above its 50-day moving average, seeing an improvement with the momentum as well as relative strength. And when we compare it to the S&P 500, it's still in a downtrend, but lately it's been bouncing back up. And the financials, this is a stronger area recently. This is looking pretty solid when we look at the sector by itself. Also, the relative strength and momentum continue to be positive. And it's showing some real improvement here, even though it's in a downtrend when we compare it with the S&P. Industrials also showing some recent strength here and improvement as we stay above the 50-day moving average, and starting to show a bit of a bounce here when we compare it to the S&P, but still in a longer-term downtrend. The tech sector, the real darling of everything, well, it's been really helping the markets to go higher lately, but now we've fallen down below its 50-day moving average, and we're seeing a real drop-off in momentum as well as relative strength. And we look at the tech sector compared to the S&P, which is still in an uptrend, but really pulling back lately. And we look at staples. These are things that you have to have no matter what's going on in the economy, and a really solid uptrend and still looking pretty good by itself. And the momentum and relative strength are turning back more positive. But still, even though we're seeing some improvement here, when you compare it to the S&P, it has really been underperforming. Look at real estate, which benefits better from a lower interest rate environment because of mortgages and refinancing and all that. But we're seeing some improvement here with momentum and relative strength and pretty much chopping sideways, but still in a longer term uptrend. But it continues to underperform when we compare it to the S&P, although it also has been bouncing back lately. Utilities, and I talked about that earlier. They came all the way back down, started to deal with their 50-period moving average, and lately have been going back up, seeing some improvement with the momentum as well as relative strength to the S&P. And really seeing some strength earlier on, then they were starting to fall back. We saw a golden cross here, then we were below it. Now we're starting to go back above it as we're seeing things chop around a bit these days. And we look at an S&P to utilities ratio. Typically, when this is going up, that's more beneficial for the S&P. When this is going down, that's more detrimental to the S&P. And after it had been going up, we've been seeing some weakness in this ratio lately. We'll look at healthcare, another defensive area, since you have to have healthcare no matter what's going on economically. Still looking pretty solid when we look at this by itself. We're also seeing an improvement with the momentum and relative strength, but still in a longer term downtrend, even though it has been improving. Discretionary, the thing that makes life fun. This has been a disappointment in 2024. We were hoping this would do better than it has. It's still in an uptrend, was starting to show a real breakout, but lately has been coming back down to its 50-day moving average. And we're seeing a bit of a decline here with the momentum as well as relative strength. And when we look at it compared to the S&P 500, it continues to really underperform. Semiconductors, a huge part of the tech sector. Seeing some pullback now, falling below its 50-day moving average, seeing a real drop-off with momentum and relative strength. Then this is a way that we look at energy versus the energy sector, where when this is going down, that means that energy is underperforming, even though it's been bouncing back up lately compared to the tech sector. And then this is a newer chart. I've had this chart for a long time, but I haven't been talking about it in any of the videos because I thought it was pretty much irrelevant. This is a ratio between small caps, which everybody seems to be in love with right now, and the tech sector, which everybody's kind of not as much in love with, but was in love with for a long time. When this is going down, that means the tech sector is outperforming. And on a longer term basis, it still is. But we're seeing the small caps really start to come on now. So we're seeing a lot of improvement there, but not enough to change this ratio from down to up. When small caps see follow through strength here and we see a cross with this ratio, that means that we can treat the nice little bounce that we've been seeing with small caps with more respect. Until then, we just have to follow the charts and see what happens. And we look at growth versus bonds here, where we're seeing a bit of a pullback, but still growth continues to outperform. We look at the tech sector and compare it with interest rates, where it's been pulling back, but still the tech sector is outperforming. Then we look at an inverse of that same chart showing how the 10-year yield has been underperforming the tech sector. Discretionary versus staples. Enough of weakness was seen here to actually give us a death cross with this ratio, but then discretionary started to outperform. Well, now it's back to underperforming again. Here's an inverse of that same chart showing how staples were outperforming, saw some weakness, now starting to outperform again. And we look at a ratio between gold and the S&P, really just kind of chopping around right now. I know a lot of people like gold, gold, gold. You got to have it. You got to do. Well, if you compare it to what the S&P's been doing, it really hasn't been outperforming. And then we compare gold to the US dollar, trying to break out here, but the dollar's been under a little bit of weakness lately, and gold has been going sideways. This is what I look at to see what's the economy looking like right now. These are high leverage loans, very risky loans. And even with all the talk of doom and gloom and we're going to go into a recession, well, this ETF just keeps going higher and higher, and it's not even back down to its 50-day moving average yet. And the momentum and relative strength still continue to look pretty strong here. We look at the NYSE composite, a broad market measure, still continues to be in an uptrend. We look at all stocks, which includes US as well as international stocks, coming back down, dropped a little bit below its 50-day moving average, but saw a bit of a bounce on Friday. Emerging markets, also in an uptrend, but coming back down a little bit below its 50-day moving average. The Japanese Nikkei index finally surpassed the 1989 highs, but since then have been under that level. The micro caps also continue to be in an uptrend, and they're kind of benefiting from the small caps doing better. And then we look at the home builders ETF and compare it with the S&P 500. Not really seeing any kind of insight here. What we look for are negative divergences. That's when we see the correlation really trailing off between the two. And even though it's going down, we're not seeing anything extreme right now. Bitcoin, which continues to be in an uptrend, came all the way back down, fell slightly below its 200-day moving average, and since then has been bouncing back up. And we look internationally, and this is the KST. This is a longer-term, slower-moving oscillator where Chinese stocks are tending to go back up after they had been declining. We're starting to roll over with emerging markets, rolling over in Europe, also seeing a little bit of weakness, but still in an uptrend in Japan, and actually turning a little bit more negative here in the US. Then here's our intermarket analysis chart where the red line, that's oil, and that had been in first place for a lot of 2024. Now it's dropping into third place. The black line are stocks, the gold line is gold, and the green line is the dollar. All of these are positive year to date. The only thing that's negative is the price of bonds, but they are potentially showing some improvement. We look at some correlations between the S&P 500 and the US dollar index. They're having a slight tendency to go in opposite directions. So a weaker dollar could end up benefiting stocks. We look at S&P to oil. Now, it depends on the context of why is oil going up or down. When geopolitical events happen and oil really goes up because of that, that's usually negative for stocks. But if oil's going up because corporate profits are doing well and everything's going fine in the oil industry, that can be positive for stocks. We're seeing a fairly strong correlated relationship right now between stocks and oil. We look at stocks and the 10-year yield, fairly strong correlation here to go in opposite directions of each other. So if interest rates are going down, that helps stocks to go up and vice versa. Also, the same thing here with the tech sector, the 10-year yield. Going in opposite directions tends to help the tech sector when interest rates are going down. And we look at the 2-year yield and compare it with stocks. This is still neutral for the time being, not really getting any edge here. Then we look at some long-term secular, which means decades or longer, as well as cyclical trends in the market. And this is a monthly chart of the NYSE composite, and we are going up above an advancing moving average. The long-term trend continues to be up. We also measure that with the Copic curve, which is a momentum oscillator, which is also looking positive. Here's a daily chart of the NYSE composite, and we look at the NYSE record high percent index. When this is going up, that is positive for the NYSE on this daily chart. And we look at a monthly chart of the S&P 500, also above this moving average, and the PPO is continuing to go up as well. So longer term, we are still positive. Then we look at the S&P on top, and then we look at a ratio between stocks and commodities, which is a variation of what we looked at before. This just shows that stocks are continuing to outperform commodities. Then here's another monthly chart looking globally, where U.S. stocks continue to outperform. And the KST, another momentum oscillator, is still pretty much flat, but it's trying to go back up. The blue line is just a little bit above the red line. So then at the end of this video, I list all those things that are positive, and then after this, I'll have a list of those things that are negative. My definition of positive is when the 50-period simple moving average is above the 200-period simple moving average. So when you look at growth indexes and value indexes all by themselves, they're both in uptrends. Copper is still in an uptrend, even though it's really been pulling back. The British pound or the US dollar is in an uptrend. Gold is in an uptrend, even though it's chopping sideways. Silver is also in an uptrend. The US dollar index, when you look at it all by itself, is in an uptrend. The CRB index, even though it's been pulling back. The biggest software companies, even though they've been chopping sideways, they are still in an uptrend. The mega caps, even though they've been pulling back. The FANG index also pulling back, but still in an uptrend. The low volatility ETF, when we look at it by itself, when we compare it to the S&P, that's when it's really been underperforming, but showing some improvement. The staples are also in an uptrend, as well as the Dow Jones Composite Average. All the different bonds that we look at based on price, except for world bonds. So we have high yield, investment grade, corporate bonds, and junk bonds are all in uptrends based on price. The tech sector and semiconductors are still in uptrends, even though they've been under pressure recently. The high leverage loans, this is what I tend to use as an economic gauge. That's still looking really solid. The Dow, the NYSE composite, as well as the Wilshire. So we have these two broad market measures are still in uptrends. The NASDAQ and NASDAQ 100, mid caps, small caps, and the micro caps, all stocks, emerging markets, and then at the bottom is Bitcoin. So our list is still pretty long of positive things right now. Then I go through and list the negative things, and this is when the 50-period simple moving average is below the 200-period simple moving average. We have a new addition here, which is the euro. That should be the US dollar. There, I forgot the U in there. Just barely. I mean, we see a little bit more of an uptick with the euro against the dollar. It's going to go back to being positive. The Japanese yen, though, even though it's been bouncing up, is still in a more solid downtrend compared to the dollar. ARK, the ETF, still is in a downtrend. The Pring World Bond Index is also in a downtrend. So thank you. I hope you found this helpful. Please feel free to check out the other videos. This is, again, more of a supplemental video. Some of you might find this video interesting in and of itself, but in my personal analysis, this is just one piece of the overall puzzle that I try to figure out each week. So have a very good weekend, and I will talk to you in the next video.